Featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Todd from FIIG Securities. If you have any questions about the share or bond market, please pick up the phone, call us 1300 30 34 35. The email is yourmoney@skynews.com.au. And joining me on the panel tonight is Mark Bailey from Equasia and Sue Wang from Mercer. Welcome. How are you?
Well.
So let's point to the fact that we've got a bit of balance now in the show.
Finally.
We've got an Englishman, so it was hard to get an Englishman in, because we were getting smashed in every sporting event, so I didn't want an Englishman on, but I'm finally bitten the bullet. But it's great to have a woman on the show.
Thank you very much.
I guess it's one of those things where you say to people, let's try and get some balance, and you ask a lot of people to come on the show, and generically a lot of guys and girls, like, absolutely no way. It's I don't want to be caught out saying anything. So we'll walk around that idea that Mercer has a lot of limitations as to what it can talk about. So for the viewers that call through and say, let's have a view on a specific stock or bond, we won't be doing that. But it's great to have you come on just to talk about the role that you play at Mercer, because it's a significant role, isn't it? It's the fixed income role within that organisation.
Sure.
Do you want to talk me through what you do at Mercer so the viewers have got a better sense of it?
Sure. So for your viewers who aren't familiar with Mercer, Mercer is a global consulting firm. I work in the investment arm, and my role is a senior fixed income specialist.
Yep.
What that means is I work with a myriad of institutional and retail clients on forming their bond portfolios. We could do simple as working out the risk return profile they need,
Yep.
as well as choosing the managers to manage that money.
So when you say retail investors, you don't mean mums and dads, you mean institutional retail offerings. So it'll be XYZ organisation, whomever it might be. It might be an industry super fund wants to offer a retail product to its members, and you say, well, okay, for the retail piece, this is how we look at it, and this is what we look to try and do.
That's right.
Mark, how are things with you? Long time no see.
Yeah, a few months.
I'm not blaming it solely on the Poms, but very close to blaming it on the Poms.
It's not my fault.
No.
We just do our best and turn up, right?
Clearly, great sportsman now, the Englishman. How have things been?
Yeah, no, very busy at Equasia. We've got our fingers in a few pies on the advisory side, on the M&A equity.
Yep.
On the debt advisory side, you probably just saw we brought Connect East to the market, which was a 7-year bond, 250 million at mid-swaps plus, I think it was 185 in the end.
When you look at what swap plus 185, so for the viewers at home, that's the cash rate plus 185, 1.85%. That's mainly an institutional play though, isn't it?
That's right, yeah. That's purely for the institutional wholesale market.
Yep.
The minimum parcel is $500,000, so that obviously rules a lot of the retail investors out. It's not listed on the ASX. It's traded over the counter, so between dealer brokers and the institutions as well. So it's very difficult for the retail mom and pop investors to get involved in that as well.
Yeah.
So, but we have, we offer a credit fund and for wholesale investors, and we can play in that type of product as well. But we've been busy as well. I mean, there's been a few offerings, single names, a bit of ABS, secondary markets.
So ABS for viewers is asset-backed securities, and so you're looking at those sorts of, like a residential mortgage-backed security, or it could be car loans, it could be all different sorts of assets.
Exactly, that's backed by specific assets. We see some value there. Again, that's on the wholesale market, very difficult for retail investors to get involved in that space as well. And also, there is some hybrids as well that we're playing and do like still at a list on the ASX.
Yeah. We're segueing just a little bit, Sue, but what Mark's talking about is something you and I've been talking about, is the diversity of the bond market. It's a much more diverse array than what you would traditionally look at in the fin review, isn't it?
Sure. I mean, one of the first things I talk to my clients about is just exactly how diverse the bond market is. Most of my clients in the beginning would probably only play in, say, cash, some government bonds, and a little bit of investment grade credit. And we're just trying to educate them on what we're calling growth fixed income. Fixed income that would be much more equity-like in its risk profile, and they could probably consider some of that alongside the equity portfolio.
Yep, so let's take it back one step. When you say investment grade for the viewers at home, you're talking about a Moody's or an S&P rating that would be what, triple B plus?
Triple B plus and above, basically.
Triple B minus, sorry.
Triple B minus.
Triple B minus is for investment grade. Okay,
Sorry,
for the analysts at home,
geek,
the people on the podcast can listen, it's triple B minus. And when you talk to clients about something with a triple B bias, do you feel that they automatically go, oh, that must be really bad because it's only triple B, or do you think that's all part of the education process? Triple B investment grade means it is actually good value, or maybe not good value, but you get what I mean?
Yeah, I mean, I guess from my side, I get a sense that the retail investor, the mom and pops, really understands the rating. Yes, they know AAA is good because they see the Australian government's got that, and other governments and a few corporates do. But I don't think they get a sense in terms of how that relates to a AA, single A, triple B, and especially on the Moody's scale of things, where you're talking Baa3, Baa1, Ba1. I can see your eyes glazing over at the moment.
Wake me up in a minute.
Exactly. It's quite technical and quite detailed, and I think you need some explanation, some education to understand the different risks that the rating agencies are trying to project.
Without wanting to say anything negative about a ratings agency, I can, but you can't. Do you find it challenging to think that they are constantly recalibrating how they rate? Is there a sense of, because I certainly felt with some of the banking institutions with some frustration around, hang on, you've recalibrated 3 months later, 6 months later, how you do mortgages in particular. Is that a sense of frustration from both the analytical perspective and from your role as an advisor looking at what the ratings agencies do? Does that become challenging?
I guess what I'm recommending was, for the most part, it would be managed funds as opposed to individual securities. We're relying on quality active managers, and they're doing the credit work themselves. So yes, then the starting point might be what the S&P Moody's rating of a bond is, but they're doing the deep dive fundamental due diligence work on each and every company and coming up with their own rating. And so I guess that's how I would be investing my client monies, with a quality manager.
And is that the same for you?
Yeah, I mean, I agree that the ratings do provide an opinion, and it's one opinion, but it shouldn't be the sole opinion for taking that investment. But change the methodology is tough. I mean, we just had this week, I think it was Moody's come out and changed the way they look at bank subdebt in Australia. So bank subdebt now is no longer AA2. I think it's A1, so it's been taken down 2 notches.
So for the viewers at home, I think it's in today's paper in the Financial Review, that Moody's have decided that subordinated debt, and remember we've been talking about capital structures, senior subordinated debt. Westpac's just done a subordinated debt issue at about 2.2, was it? Something like that. It's listed on the stock exchange. And Moody's have come to the conclusion that there will not be the level of support. They've come to this analytical assumption from the government will not be able to support the subordinated debt, and by that they mean that historically, if Westpac got in trouble with that subordinated debt, they'd assume the government would step in and help. They're saying that they don't think that will happen, and so the government will be encouraged to coerce the subordinated owner to take a haircut. That's the view.
Yeah, and again,
that doesn't mean sell your sub-debt because this has happened, and that just means that's their interpretation.
The quality of the sub-debt hasn't changed overnight. It's just the way that one agency is looking at that, and it's actually brought it more in line with, I think, with S&P's, which is kind of rated at A- anyway. So, it's kind of a similar type of rating now, mid-single A's. So it is what it is, and I don't think there's been too much in terms of price action as a result.
Okay, so we'll talk about a little bit later about some of the listed paper after some of the breaks, because it's interesting how the different bodies have come back to talk about hybrids and about the role they play and how they've been sold. So we probably need to have a whole little segment on that. But what I wanted to ask you about was we've got non-farm
payrolls tonight, big night.
Big numbers. Let's talk about the taper. What's your interpretation? What do you think? And taper's a big deal.
Taper's been a hard slog for me. So I guess, even though the Fed has tried really hard to well telegraph their intentions, when Bernanke first uttered the word, it took markets by surprise. So you had May and June, there was a fair bit of volatility in both bond and equity markets. The last couple of months, the market has been digesting that tapering is coming, and the consensus is around that taper will start as soon as September, in a couple of weeks' time. Now, obviously, big deciding factor will be the non-farm payrolls out of the US tonight. I think if we get a very, very bad number, something that's 5 digits, less than 100,000,
Yep.
It may push them back in timing, but I think markets thinking that they'll at least start tapering, even if it's a little bit of a reduction this month.
Your thoughts?
Yeah, I think it's got to be a really dreadful number on the non-farm payrolls tonight. I think the consensus is 180,000. If you maybe get down to 50,000, then maybe. But I think even then, the Fed has telegraphed this so much, and it needs to start the tapering, else it's just going to cause huge uncertainty and more volatility in the markets. And I think a lot of the heavy lifting that has been done in terms of the price action, so you've seen yields back up, bond prices go down. If they say we're not actually going to taper, then those price action will reverse, and they'll have to take the pain sometime in the future. So I think the Fed will go through, even if it's tapering by 10 billion rather than maybe the 20 billion that
we'll start talking about the pain. Happy on Monday. Look, we'll be still talking about some more tapering after the break, but we'll leave it there and we will go to a quick break. If you have a question for the panel, call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Welcome back to the Bonds and Equity Show, your edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities. Joining me tonight is Mark Bailey from Equasia and Sue Wang from Mercer. They're here to answer any of your questions on 1300 30 34 35 and the email is yourmoney@skynews.com.au. I mean, clearly there's a big event. We've spoken about it. It's South versus the Roosters, that's the number one event. So everyone will be watching this on the podcast or on the Sunday or after that fantastic game. I'm sure it'll be great. But we have been talking about the new Fed governor, and we think that's a significant event. And to some extent, I want to get your thoughts on why that's relevant to the Australian investor, and maybe if you've got a sense of who you might think it will be, or how they will play out differently. So if I could start with you, Sue.
Sure. I mean, whether we like it or not, our bond market is heavily influenced by the US, and that's probably the main reason why we care who the new governor would be. Obama gets to decide, although his Senate has to approve, and at the moment the race is between Janet Yellen and Larry Summers. Now the pendulum swings regularly between what the market thinks it'll be, and at the moment it's swinging towards Summers.
Yep.
Now Yellen is seen as, I guess, the safe choice. She's the one that with plenty of experience, and she's very aligned to Bernanke's views. Summers, on the other hand, might be a bit of a maverick, although to be honest, tapering will probably be well and truly underway by the time he or she comes in February next year. So I don't think they'll deviate much from the current tapering plan.
Right. What about you? Who do you think?
I think it'd probably be Janet Yellen. There's a Wall Street Journal article today which again swings back towards Yellen, saying some of the politicians have got issues with Summers, and I think generally Sue's right in terms of Summers is generally seen as more hawkish and Yellen's more dovish, which means that probably give the market and bond market a bit more support, so you might see a bit more pressure on yields to come down rather than up. But if Summers comes in there, he's seen as a bit of more of a maverick and a bit more independent, I guess, so you might see bond yields kind of rise a bit because you'll see maybe tapering go through a bit quicker.
I saw a quote by one of the Kansas senators that said he wouldn't let Summers mow his lawn. And I thought, you know what, I really want it to be Summers, because imagine the theatre. And what I don't quite understand, Obama is clearly a gifted politician. You don't become the president and you don't conduct yourself the way he has without being gifted. Yet he's delayed this for such a long time, and he's essentially what they would call a lame duck president last term. His agenda should have been organised in the first year or two, and it's all that sort of stuff. And yet he doesn't ever put this fire out. He doesn't ever say it's not going to be Summers. He defends Summers. And I wonder whether it's that contrary to the lame duck. He wants somebody who is going to be combative, because it'll be an incredibly combative experience to see Summers to go through the Congress and try and get confirmed. That'd be great TV. Forget the Roosters in the South. That would be the TV show to watch. That'd be great.
Well, I guess some commentators are saying that he'll be no more combative than, say, Greenspan was.
Yeah.
So, I think it's mainly that his stance on monetary policy hasn't been as well documented as, say, Yellen. So he's a bit more of an unknown to the market.
Yeah. I suppose to some extent the thing that's caught my eye is the fact that we talk of tapering. Interest rates have gone from very low levels. We were talking about the housing market. The mortgage rates have gone from the low 3s to the mid 4s, and that's significant in the course of this year. But the governors have, they've continued to buy the 85 billion. They've bought these treasuries while they've talked since June, and the market's gone up, 2%. It's gone up a lot.
Yeah.
what do you do in this? The worry is interest rates. So the bond bashing is about interest rates will get crushed. What do you do? What's the strategy you're telling your clients?
That seems to be all I'm talking to clients about at the moment. Like May and June were pretty ugly months. Anyone that was holding fixed rate bonds, got a bit of a capital loss. And so what we've been looking at is ways to reduce the amount of interest rate risk in client portfolios, whether that is shifting towards lower duration or shorter maturity bonds, maybe moving into floating rate bonds. And for those who are in managed funds, looking at considering absolute return strategies, which are much more cash-like and thus have a shorter duration.
So for the viewers at home, when Sue's talking about that closer to duration, I hope you remember a few weeks ago, that's getting closer to the cash rate. So you're shortening their tenor. Your investment is either 1 year, 3 years, 4 years, 5 years. And what Sue's talking about is getting closer to that 1 year bucket or whatever level. What about yourself? What do you think about? What's the strategy?
I think that's exactly right, and also you can buy higher coupon bonds, which again has the impact of having shorter duration. But yeah, floating rate, and also to the extent you can maybe move down the credit spectrum as well to pick yield up. We're seeing some globally the phenomena where people are moving out of the longer duration bonds, the longer maturity government bonds, into the shorter duration floating rate, lower credit rating, so maybe into the high yield space as well. But I saw an interesting statistic on the performance of fixed income funds. Year to date, I think they've fallen by 4.5%. This is a US Merrill's bank index, and that's the worst performance in nearly 40 years.
Yeah, it's unbelievable.
And if it's only fallen
compared to the equity market,
exactly, it's fallen 4.5%, and that's the worst performance in 40 years. It just emphasised to me the importance of having bonds in a diversified portfolio.
When I talk to our salespeople and they say, well, hang on, interest rates have gone up and clients got fixed and they're going to lose some money, and they say, what would I do? I say, just think if you're in the equity market, what did they do? Because these things were getting absolutely belted out of the park. You should buy some more. Really, So I think you've got to understand why you've gone into that bond piece. If it's a hold to maturity trade, you're not affected by the volatility. If you're looking to trade credit, that's a different scenario. Jade, what we're going to try and do is bring up, if Jade can hear us, because Jade is miles away from us, she's going to bring up a chart and we're going to talk about these two different types of credit curves. So the chart here that we're about to show you is the purple line, the line down the bottom, and for those in the podcast you won't be aware of it, is the US Treasury curve. The line in blue, the next line up, is the difference between the credit curve, so the US credit market, so A-rated credit instruments, GE, those sorts of organisations, and don't correct me if they're not A-rated. So the difference between those two, and you can see that that's quite consistent over the course of the curve. The orange line is the Australian bond market, the Australian curve, and the green line is the Australian credit curve. It's the same equivalent as the blue line, but in Australian dollars. It's clear when you look at those two curves, or those four curves, but the ones that we're looking at, the one right now for us is this green one. You can see how if you're buying those longer dated duration, the strategy for those clients is to hold that longer dated one and roll it down as it gets closer to the duration, closer to cash rates. And you can see that you would pick up a lot of benefit. So the idea is, it's the Rumsfeld portfolio. If you're going to buy some fixed income assets, you can buy some fixed, you can buy some floaters, you can buy some inflation-linked bonds, and you're trying to cover yourself from that volatility. So what we would look at is in that bucket, that 6, 7 and 8 year part of the curve, as it comes closer down, if you take the view that the regulators have got it right, that interest rates will stay low for years, well, you'll be picking up 6 and 7% returns, and you'll come down the curve closer to where it's 2.5% cash, and that becomes a very attractive investment for some people. It's just a question of whether you can absorb the volatility, but from a strategy, when it gets that wide, you think they'll coalesce around that number.
Yeah, I would just add a couple of points, Toddy. In terms of the kind of the pickup or the difference in yield in Australia, against from the corporates to the government bond curve, so that's from the green to the kind of pinky orange. You need to only move out to 4 years before you start to see a substantial pickup. Yeah. Whereas in the States, you need to kind of move beyond 10 years before you get a big differential between there. And another point as well that I'd like to highlight to viewers is the Australian government curve, again, the one in orange, stops after 15 years. Now, the AOFM, which is the Treasury organisation that issues bonds, has done a great job trying to extend that curve out, and probably will extend that further. I think there was a 20-year linker issue as well, but this is on the nominal side of things, and that will help develop the corporate bond market within Australia. We keep talking about that every time we're on, that allowing Australian corporates to issue domestically longer term is a good thing for our economy, and it will also help infrastructure. Now, the AOFM will continue to extend that curve out, and they will issue longer dated bonds if the demand is there, which hopefully it will be, and that will allow other projects such as the infrastructure that maybe the new Liberal government...
Treasurer designate Hockey has come on saying...
and said 30 to 50 year bonds.
30 to 50 year bonds, hasn't he? So he said that he expects over time, so I guess that they'll go 20, 15s to 20s to 25s to 30s and move that out, because there's a great deal of appetite. Without wanting to talk about the politics, how's he going to sell that? In terms of no more debt, that sort of mantra. Do you think that was the electioneering, and therefore, because there's great demand, isn't there?
There's great demand, and certainly I agree, Mark, that it will help sort of lengthen out that very sad-looking, green line. Really, like any Aussie corporate who wants to try and get longer dated debt than say 8 years has to go offshore to do that. We shouldn't have that kind of situation in this country. So.
Yeah, I mean, there is 10 years, and there is institutional demand for 10-year triple B paper, and that has improved. But I think in terms of the debt ceiling, it's all politics. I mean, as far as I'm concerned, and it's a personal opinion, whether you're an individual, a corporate, or a government, you shouldn't run deficits over the long term. In the short term, it's fine, and even then, it's okay if it's manageable. Now, Australia's gross debt is only at 27% compared to the States at over 100%, Europe at 90%, so we're nowhere near those types of levels of extreme.
We'll talk about that after the break, because we can talk about how you can use the money for good, you build up your infrastructure. We have to go to another short break. Feel free to call us or watch the footy on 1300 30 34 35. Email yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. It's the bonds versus equities editions. If you'd like to speak to anyone on our panel, please call us 1300 30 34 35. The email yourmoney@skynews.com.au. Sir, if I can just start with you. You mentioned earlier in the show about absolute return managers. Can you just help me understand what that is and what you look for in those types of managers? And I guess it's because we're looking about how that fixed income, that fixed return has different strategies. So what are you looking for in absolute return?
What I'm looking for is a manager that is going to be mixing all sorts of value-adding fixed income strategies to build a portfolio that ultimately returns you something like a cash plus 2 to 3 return on an annual basis.
Plus 2 to 3%.
So I guess where cash rates are, that'll be a 4.5% to 5.5% annual return. And what the investor should be able to expect is a nice steady stream of income and fairly low volatility in their underlying capital. And because of that profile, it suits post-retirees very, very well. But in the current rising yield environment, even my institutional investors, the large super funds and insurance companies that I consult to, are moving parts of their traditional fixed income portfolio, which have a lot of that interest rate risk in them, into some more absolute return strategies.
So if I think of people who are disappointed in where term deposits are, is this where they should be looking, that sort of absolute return fund manager, where they can find the right one?
Sure, I think it's a natural progression from a TD type scenario.
So as you get comfortable with that fixed income component, TDs, you then might look for use your education to learn about what fund manager might suit, and clearly you can't talk about any because they're not Mercer clients on the show. But it's the same thing. There's enough information around there, isn't it? It's about how do you go about finding information on fund managers, other than Equasia being the best we've ever seen? But other fund, how do you do that? What do you think? How would you advise the viewers to go and find good fund managers?
You go onto their websites, and they'll have a PDS on there in terms of explaining what their target is, what their volatility is, what type of investments that they have. That's what we talk about in our fund as well. We say we're targeting UBS composites, bank bills plus 300. And our income is around about 5%. So again, it's targeted for what you were saying in terms of the retirees. It's got regular income that we try and reduce volatility by having a diverse portfolio of asset backs versus corporates versus hybrids. But in terms of the term deposit and where those rates are at the moment, they're kind of almost artificially high because banks are still fighting over deposits. And yes, they have come down, But even at 4%, which you can get probably for 9 months to a year term deposit, they're still very attractive when you look at the actual government bond rate, the semis, and also higher rated corporates. You almost have to go down really into the hybrid space, which if it was rated would probably be sub-investment to really get a yield pickup. So you almost kind of need a barbell strategy where you have some term deposits and you have some kind of the higher yielding corporate names and hybrids, because everything else in the middle is kind of lower than the cash rate is at the moment.
Yep. And I suppose it's there for a reason, being that they think cash rates are going lower.
It is, but also APRA is forcing them to, fund less on the wholesale offshore market, and bank deposits are looked at favourably in terms of the liquidity requirements as well. So the whole Basel III impact as well. So they probably will stay higher, and we won't get into the rates debate at the moment, because I think that's going to come up in another section. But they're artificially high if you look at that compared to where the governments are on semis.
Let's talk about where the governments are, because you brought in a chart, and I've been talking about this for a while now. We have a regular viewer called Sue, and we used to have Sue's Bond School, but now that I've got Sue on the show, I just don't want to think that it's your Bond show. But the Bond School that Mark will bring about, you've got your chart here, and your chart is on the sovereign curves. Do you want to walk the viewers through what we're looking at here?
Yeah, so this is the US and the Australian curves. So the curves as of today are the darker curves. So the US curve is in blue, and the Australian curve as of today, the sovereign curve, the Australian government bond, is in green. Below each of those, in the lighter shade of blue and green / yellow, is what it was at the start of May. So that's kind of pre the tapering talks. And what it shows is that both curves, the US and Australia, those government bond curves have shifted higher. But not only have they shifted higher, they've also steepened, and by that I mean there's been a bigger change in yields. The yields in the 10-year and 30-year on both the US Treasuries and also the Australian government bond have moved higher than they have in the shorter end, kind of less than 2 years, and kind of a year and 6 months they've hardly moved at all.
So for the viewers at home, it's becoming more of a funnel as opposed to being consistent. You can see how they're creating funnels around that duration, that length, and it's a classic steepening curve where people are less likely to give you money for longer durations because they're unsure of where interest rates are going. So that duration issue becomes critical if you're looking to borrow money from the longer dates.
Yeah, and typically a steeper yield curve is actually reflective of a healthy economy, one that's growing, one that's potentially going to have inflation down the line. Not too much inflation, but just a healthy amount. But this impact here that you see in the charts where it's steepened is purely due to the tapering impact of the Fed, where the Fed is saying we're no longer going to buy those longer dated 10, 30-year bonds, RMBS, and that's probably likely to come through in September. So you've seen investors selling that because they don't want to be kind of the holder of last resort, and that's why you're seeing the curve steepen.
And to some extent that then becomes a bit of a concern, because clearly the economies aren't strong. Global economies aren't as buoyant as you'd like, and for a range of different reasons. We've spoken about this on the show. So when our Fed, various policymakers across the world look at these charts, they say, well, I've got to move that long end, I've got to put a flattener on, I've got to actually make that long end buy, and I need to convince somebody else to buy it. What strategies are they going to use? How can they do that?
Well, the Fed's come out as firmly as it can to suggest that even though they might be starting tapering soon, and indeed even when tapering is concluded sometime, say next year, that by no means means that rising interest rates in the US are happening anytime soon. If anything, they're still a long way away. They've tried as much as possible to articulate that to markets. I think this steepening is just, I guess, the market's initial reaction to the tapering comment. And I think we'll have to see the pace of that tapering and also more economic data coming out of the States. That will determine, I guess, the future shift in that yield curve.
Mark, do you see this also as an opportunity for traders to trade, just to, try and catch the Fed short, just try and make them break the back? Because clearly with the way the mortgage market works in the States, if you can get those rates up, then the banks have to hedge themselves and they sell treasuries. That's the only thing they can do.
I mean, it's always an opportunity for traders to trade, especially on the government bond side. I mean, that's what they're paid to do, and they'll
because it's so liquid.
Exactly, and they to make positions and put their money where their mouth is. So there will always be that kind of trade. I don't think you're seeing any particular positioning strongly or the other. I think this is just the market reaction that we've seen, and we've seen probably even a more significant reaction in emerging markets in terms of the currency and also in terms of the equity markets of India and Indonesia, where currencies have fallen, depreciated 15%, equities have been down 20-odd%. In the 10 years, that move is probably equivalent to a 7 or 8% capital loss if that's the only asset that you have in your portfolio. So if you're looking at an equities market that's unhedged in India, you're down 35-40%.
I mean, the emerging markets have been absolutely taken to town, haven't they? They've been belted.
Because again, it's that Fed excess liquidity that's a fear of coming out of the markets, that it's going to go back home. So all the hot money that was chasing around the world to try and pick up yield, pick up income and dividends is flowing back to the safe haven of the States, and that's why you've seen, again, a weaker Aussie dollar as well against, and the stronger US against most of the currencies in the world.
You can imagine that will continue on, that stronger US, particularly these higher rates. The US guys saying, well, hang on, this is 5%, in 30 years I'll buy that. Yeah. We'll have another quick break, but please feel free to call us 1300 30 34 35 and email yourmoney@skynews.com.au. We'll be right back. Welcome back to the show. Your money, your call. It's bonds versus equities. If you have any questions on the bond or equity market, please pick up the phone 1300 30 34 35 and email yourmoney@skynews.com.au. We've had another email come through. We've had a few emails today on the inflation piece, so we're going to take one from Liam. And Liam writes, hi, we have very low inflation, so why should I be worried about inflation at the moment? Liam from Parramatta. Sue, can I hand over to you?
Sure.
We have very low inflation, says Liam. Is he right?
Well, Liam, let's just address what you believe to be low inflation. I guess with inflation currently sitting smack bang very comfortably in the middle of the RBA's 2 to 3% range, I would argue that we don't have very low inflation. We have controlled inflation in this country. And indeed, if you compare it to other countries, we have much higher inflation. Should you be worried? I would say in the near term, you don't need to be worried. However, the reason why there are people out there talking about inflation fears is because the amount of cheap money, when I say cheap money, I mean the fact that we've got a lot of zero interest rates around the world, we've got a lot of QE in the US, in Europe, and Japan's just jumped on the QE bandwagon too. That cheap money is likely, or possibly likely, to result in some inflation down the line. And so that's probably where you're hearing a lot of this inflation fear-mongering going on.
What do you think about it? I mean, compared to the rest of the world, we have high inflation. The rest of the world's got zero, doesn't it? It's nothing. Deflation. So what's your interpretation of the inflation story? Do you think it's, to some extent, people have just become blasé about it? 2.5, it's nothing.
Yeah, I mean, I guess initially if you kind of go back a few years when the Fed actually started on QE, I was actually quite concerned that that would lead to fairly hefty inflation, but we haven't seen that come through. And I think Sue's right. I think down the line we will see inflation, and with higher inflation comes higher interest rates because most central banks have got an inflation band that they target. So that's very important if you're in a fixed income portfolio. It's very important if you're in equities that you're going to have a higher interest rate. So therefore, you need to protect against that.
Do you ever feel that the investor, most investors, don't appreciate the impact of the inflation? That the Feds are absolutely obsessed with it. Equity markets not so much. I'll just buy Westfield. I think people who can lift up rates. Do you feel that they just become blasé as an investor, but the people who are scared of it see there's the 900-pound gorilla is the Fed? Do you feel that disconnect?
I mean, not really. I mean, I think it's always an issue, but it's like anything. If it stays quiet for long enough, we've got bigger issues at the moment to worry about.
I suppose what I mean is, are your clients talking about inflation to you, saying, I want protection against inflation, or is it just you going to them and saying, you need to get protection? That's probably more my question.
Yeah. From my personal experience, I would say that clients aren't really worried about inflation at the moment.
What about you?
They're worried about it down the line, and they want to start thinking about it now. We're the chicken. We're screaming. The sky's falling in, and they're going, whatever. Just let's go and enjoy ourselves. Tell me about the interpretation of the different bond markets across the world. I mean, we are talking about the idea of that we have a very small bond market compared to the rest of the world. It is sizably smaller, isn't it? And particularly this sort of the exchange traded piece. Our over-the-counter is probably big enough. It's big,
But in terms of the penetration of the rest of the world, we don't penetrate anywhere near as much as the rest of the world, do we?
No, I mean, the government bond market is obviously a factor about the size of the deficit, which the politicians are trying to reduce again, but it has increased significantly over the short term. And in the corporate bond space as well, it's still relatively small but growing. And as you say, that the exchange traded fixed income is incredibly small compared to what we're seeing globally. It is getting bigger, but the more liquid markets are those in Europe and in the States as well. Japan and some Asian markets is a significantly more liquid than the domestic markets.
Yeah, I think I saw in that ASIC note it was 50 billion in hybrids, and there was 390 billion in equities, and we're really worried about that hybrid market. Really, that's quite extraordinary. Who was writing that? That was an amazing statement to me. I guess when you and I were talking to about what drives some of the attitudes toward markets, let's talk about what the structural impact between defined benefit versus defined contribution. How does that play out, do you think, in terms of investment thesis?
Sure. So I guess what they are, for those viewers who aren't familiar, are, I guess, pension schemes or superannuation schemes. And what we have in this country is a defined contribution. All that means is that the contribution made by your employer is fixed, it's defined, and currently that's sitting at about the 9.25%. What isn't fixed and what isn't defined is what you get when you retire, that jackpot at the end of the working career. In the case of a defined benefit scheme, which is what's more popular in the US and in the UK, what you get at retirement is defined. But what happens is that because it's defined and your employer has to pay that, they are the ones who are investing the money for you. Right. And so typically they choose to have much more bonds and much more low risk assets to reduce the risk of them not having enough money in the end to pay
the
out.
obligations on the employer. We're going to have to go for a quick break because I still want to talk to you about how that plays out in the UK. But we'll leave it there. We'll be right back in a moment with another call and have a quick break. Welcome back to Bonds versus Equities, your edition of Your Money, Your Call. We're still taking calls. Please give us a call on 1300 30 34 35 or the email yourmoney@skynews.com.au. And we have our first caller for the night. It's David from Canberra. Hello, David. How are you?
Good, thanks. How are you?
Pretty good.
That's good. I just had a question on equities.
Yeah.
It was just I'm thinking of investing for the next 10 years. I was wondering if the panel could give me their tips on equities in that time horizon. I was thinking good companies like CSL, CPA and Woolworths. Do you think I'd be better off investing in those or investing in, say, the ASX 200 or something along those lines?
Okay. I suppose there's something here, David, that my interpretation is the first thing we would say is we don't know enough about your different risk parameters and your profiles and the like, and your age and so on and so forth. One of the things we do at FIIG is try and come up with some metrics around how old you are as the amount of bonds you'd have, and then from that you need to have some growth assets. So to be invested in blue chip growth assets in the Australian equity markets is not a bad idea, it's a good idea. Which ones you should buy, I look at the four majors and any, many, miny, mo. You look at all those moats that surround businesses, but in terms of would they be better, CSL versus CBA, that's not where we're going to be. But clearly the most important thing is to try and get some advice around what best suits you and find the right advisor. I don't know that that's going to be that easy, but it's about the education. But in terms of the majors and the Australian blue chips, things that will be here over the 10-year horizon would be good. If Dr. Stephen Nash was on the show, he would tell you to buy a zero coupon bond, because what you've then constructed is a capital guaranteed product. So he would say, put money into something from a state issuer, Victoria, New South Wales, those sort of issuers that is a zero coupon bond, and you can look that up on at FIIG, and we'll tell you what that is. But essentially, you put down $20, and in a period of time, they'll give you back $100. So your capital is guaranteed, and then you can have a crack at some of those equities that might, suit your profile. Hopefully, that's answered your question. And thank you for ringing. What I wanted to go back and ask you about was the annuity, business that comes out of the UK. How is that changing? Is that still a big driver? Sue was talking about the defined contribution versus the defined benefit. The corporate has the responsibility, so he's got to make sure you get your $100. How's that playing out in the UK?
In the UK, we have a situation where you have your super money, and the day you retire, you've got about 2 years where you have to use at least 75% of that to buy an annuity. And that annuity can be either linked to inflation, CPI, or it could be a constant payout per month until the day you die. Now, the reason why the annuities are used in the UK is so that people don't run through their super, in 2 years and they live for another 20 and they become a burden on the state. Now, the reason why annuity is good, and I think that we should have that as a stepping stone in Australia, is that it does lead to encouraging longer term investment decisions from portfolio managers that need to match those 25-year liabilities with 25-year assets, which generally could be infrastructure or longer dated government corporate bonds. So again, that helps fund infrastructure type projects, which again the Liberals are talking heavily about, and helps to square that circle of trying to give some demand to the potential supply that's out there when these infrastructure type projects do lend themselves to longer dated type issuance where there's no refinancing risk. You just lock the funding in, you give them to the portfolio manager that's investing for the annuity long term, and they pass those benefits on to the end investor.
I'm a massive believer in the infrastructure trade. I think it's a great idea, but it's become a little bit tarnished, don't you think, in terms of the public-private partnership trades haven't quite performed. And I'm thinking now more about toll roads. How many cars go through that toll road? And there's arguments in Queensland about was it 4 cars, 5 cars. And that becomes a challenge for them, doesn't it? It becomes a challenge from policymakers to create that right product.
Like any asset, I guess you probably want a portfolio of infrastructure in your in any client's overall portfolio, and I guess just picking a specific toll road, always has that lack of diversification risk. So I guess because my consulting to clients revolves more around managed funds, we have placed a fair bit of money into what I would call infrastructure debt. So rather than owning the equity in an infrastructure asset, you can lend to an infrastructure asset. The lovely regulated cash flows that are typical of many infrastructure assets just means that that's a nice sort of steady stream of income again for the
I love the way you
investor.
describe it, that lovely flowing return of cash. I like that. As the guy buying that, I'd be saying, I like a lovely return. While we've got you, tell me about the portfolios that you're developing for your clients. If I come in, I'll provide me with 2 types. One is I want very little risk. What would you suggest that portfolio looks like? How does that play out? And then those you were talking about earlier in the show about those equity-like bonds. The equity people watching the show, which is maybe about 4 or 5 of them, will be angry when you can find some equity-like bonds. But let's say we start with the conservative piece and then go to the equity one. What are we looking at?
Well, I guess traditionally a conservative client, we would have moved them from cash or TD-like portfolio up to some sort of bonds portfolio. The problem with bonds, as we've articulated a couple of times today, is that in a rising yield environment, fixed rate bonds deliver you ugly negative capital returns. So in that situation, that's where we're advising on the absolute return style of investing, that more cash plus style of return. For the souped up clients who would like a little bit more power in their bond portfolio, we're talking about growth fixed income, and the growth really comes about because these assets are much more equity-like in their makeup. Things like, I guess, emerging market debt, lending to the sovereigns of emerging markets, high yield bonds.
Emerging markets, India, China, Brazil. That's what we're talking about. Indonesia
Potentially, definitely Brazil. Liking Brazil on the debt front. India and China are a little bit harder to get access to.
Right.
But
and we've got a caller, so we're going to take that call in 1 second. But you're now talking. It's in US dollars, isn't it? That's traditionally what the currency you're lending in.
Traditionally, it's in US dollars, but increasingly these countries are issuing in their own currency. Lucky
that. We have a caller. We have John from Sydney calling. Hello, John. How can I help you?
Hello. I wanted to ask about, there's been countries that have printed money before, like Zimbabwe, Argentina, etc. And I was wondering if there's firstly any developed countries have done it before, like what the US is doing now, and under what circumstances could US, if they keep printing too much, become a Zimbabwe or Argentina? And also I wanted to touch on the private debt levels in Australia. Apparently a developed country can get out of debt by printing. What can they do for private debt? as versus government debt? I mean, you can't print your way out of private debt.
No, I mean my wife's tried. It's just not happening. John, I think if I can take the private debt first, what's really interesting to me is that the rate at which we're paying debt off as globally, it's phenomenal. It's because they've learnt from the GFC, and that's created, John, that's created the problem for the policymakers. The policymakers have lowered interest rates, and they thought everyone would go and buy flat screen TVs. And I can tell you, Michael Harvey's a friend of mine. He said they're not buying that many, and it's the challenge is trying to get the consumer to act like it had traditionally acted. And John, so what they're doing is they're paying off that private debt because that lowering of interest rates, they're keeping their wages, their jobs, and they're paying the debt off. Am I, house ownership?
I mean, that's right. I mean, and I think if you look through history, there's been plenty of countries. I mean, I think when the countries went off the gold standard, for example, that was an extreme case of essentially printing money. The currency was no longer tied to the gold standard, the amount of gold reserves that you had. The UK's been doing QE as well. So, but equally, that it does actually have an impact, or will through inflation have an impact on private debt levels. Inflation is a great healer of debt, because your nominal debt levels will stay the same, but inflation helps to increase the asset value, so your proportion of debt decreases.
So one of the things that, John, I think we should point to is the fact that the US issues it in US dollars, and so everyone else takes the responsibility of giving them back US dollars. And in the event inflation and the dollar devalues, the US doesn't care. They reap the benefit of that, don't they?
I guess called inflating your way out of your problem.
Correct. Absolutely. We haven't seen, to John's first question, have we seen this before? We haven't seen anything like this in the world.
Not to this scale.
This QA, not at this scale. Okay, we'll go, hopefully that answers your question, John. We'll go to a short break and we'll be right back for our last segment. And good evening. Joining me for the final segment of Your Money, Your Call is Mark Barley from Equasia and Sue Wang from Mercer. They're here to answer any questions if you've got one in the next 15 seconds. Mark, I just wanted to get your thoughts, because only a few minutes. Healthscope, MYOB, they reported their results. You were here about MYOB last time. What's been happening with both those organisations?
Yeah, MYOB had an acquisition in New Zealand, Banklink, so that's gone well. They're still integrating that. Private equity chipped in some money, so that was positive. The preliminary results that they've came out with, revenues are flat, EBITDA is up slightly, so they're ticking along okay. We need to get an investor presentation that will come out in mid-September, September the 16th, and there'll be a conference call then, so we'll be able to get into the details of the divisions and the EBITDA and kind of what's happening there.
So that's September 16th?
September the 16th on Monday.
So those of you who are interested in MYOB, please email us and we'll let you know what's going on.
Yeah, it's on the ASX website. They've put out a release in terms of the time of that conference call. Healthscope's had its results, and the top line was up about 5%, I think. EBITDA was up around about 8%. Conference call was well attended. Still a lot of equity analysts following that, so I guess they're expecting that to kind of come out from private ownership and maybe have an IPO listing sometime in the future. Management did state, so don't get too excited, that that's not on the horizon, but the amount of equity analysts still asking questions on the conference call was an interesting observation from my side of things. But Healthscope seems to be ticking along very nicely as well.
Both doing well, and both are hybrids.
Correct.
Right. So let's. ASIC came out, and the viewers would be aware of it. I think they'd probably be getting a lot of the planner community talking to the customers about what ASIC said, and I think essentially. I made the point before. It's a small market. ASIC's worried about small markets, and I know. I can see why they'd be worried about big markets, but anyway, they're worried about this. It's all about the education, isn't it? It's all about the fact that people are changing the way they do this issuance because they're meeting with new requirements. Basel III, APRA, ASIC. So there's different parties at play. What's the answer?
Look, I think ASIC's right to protect the retail investor, whether it's a big market or small market. And that's what it's trying to do with the report. It's trying to help investors not just look purely at the return, which could be 10, 15%. And the name. Look at the underlying credit quality, get a sense of the risks involved in that. And if you don't understand the risks, don't buy the product. It's a pretty simple thesis that ASIC's got, but investors are getting blinded by a certain name that they recognise and don't really understand whether that's a risky investment or not risky, and whether they're getting paid for that risk.
And so do we call that driven by the distribution channel? So the people who are selling it might be the stockbrokers, people who are not quite as familiar with it. Do you feel that that's with Mercer, it's the same thing, you're about educating clients all the time?
Well, I guess what we're trying to do with our client base is, yes, there's certainly been that chase for yield. As yields have come down across the board, hybrids have looked like an attractive opportunity. And the biggest issue with our clients is they'll look at a name that they recognise, they'll look at a lovely big yield number, and that's the one they go for. The problem is the difference between hybrids can be vast. Some are very equity-like, some are much more bond-like, and they really need to do a bit more research on each of them.
There's a great article for the viewers who want to email through. I'll send it on. But Chris Joy, who'll be on in the next couple of weeks, wrote an article in, I think it's called Capital Magazine, which is the insert to the Financial Review, and I think it's on Wednesday or Thursday. And he sums up the hybrid market in a really concise manner that says you've got to price those risks and what those risks might be. So, it's a good article from Chris. That's all we have time for today. Thank you so much to our guests, Mark Barley from Equatia and Sue Wang from Mercer, and to you, our viewers, for the calls and the emails. Until next week, I'm Mark Todd from FIIG Securities. Have a great weekend. I hope the footy is fantastic.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.